Thanks for joining the Deal and R. Donnelly's Energy 2016 Dealmaking Outlook Oil and Gas webcast. I'm Daniel Perez, Director of Business Strategy for Venue, R. Donnelly's virtual data room platform and end-to-end deal solutions suite. The oil and gas industry is facing the worst downturn in history after a 70% drop in oil prices just since the summer of 2014. With no recovery in sight, companies are laying off workers, cutting capital expenditures, and trying to sell off assets just to stay afloat. With the equity and debt markets only open to stronger names, some companies are starting to look at restructuring options, even bankruptcy, in a year that many predicted would result in capitulation if conditions didn't improve. Yet, despite bargain basement prices for companies and assets, deal flow has been slow, with only a few major asset sales and occasional strategic deals being announced. Private equity firms in particular have even been largely on the sidelines, instead preferring to fund startup companies, despite having raised tens of billions of dollars in investment capital over the last few years. So the big question here is, when is the energy market going to rebound? And more importantly, in the meantime, what types of deals are going to be forging ahead to get oil and gas companies over the slump? Joining me today are Andy Calder, partner at Kirkland & Ellis, Ken Hirsch, CEO of NGP Energy Capital Management, and Wayne White, Managing Director of Bankruptcy and Restructuring at Eisner Amper. We'd like everyone watching to be a part of today's deal-making conversation, so please submit your questions just to the right of your browser. Now, before we get started, our panelists just wanted the audience to know that in some cases, they can't discuss specific companies, and the views and opinions discussed here are their own, and aren't necessarily the ones of their firms or the clients they represent. So let's get started. So Ken, did you foresee the downturn in the oil and gas industry, or particularly the extent to which it's actually hitting the companies?
Well, I don't think anybody foresaw the dramatic drop in commodity pricing that we've seen. I would say if you roll back the clock to 2011, 12, and 13, what we did see was high prices causing instability in the market where high cost supply was coming on, excess returns were being realized, and whenever you have those kinds of dynamics, it's only a matter of time till you look back and say, this is kind of an unnatural event. It was masked at the time because of the global disruptions. So the U.S. was increasing its oil production from 5 million barrels a day to over 9.5 million barrels a day. But Libya had come offline, Iran sanctions had taken 1 million barrels offline, you add in Syria and Yemen and other places. It was just really that growth offsetting these disruptions that were sort of unplanned. So ultimately what was happening while prices were high was you were sowing the seeds. Nobody saw it coming. I mean, we're both buyers and sellers, so we're kind of in the market and we can see valuations move, but it really wasn't until OPEC decided that they weren't going to just stand back and let non-OPEC producers increase their production.
Okay. So how exactly has the downturn played out? Is it a slowdown just like we've seen in the 80s and 90s? And are there any lessons to be learned from what's taken place here?
I think the speed at which it hit was really unanticipated. I think it hit quickly around Thanksgiving of 2014. And then it's just really taken everyone by surprise in terms of the extent and the depth of it. I mean, obviously, oil and gas is a cyclical industry, so folks have to expect some kind of a downturn at some point. But the extent of it's taken folks by surprise. I think in the early days of this downturn, folks kind of anticipated it might be a V-shaped recovery, which means it would go down and then bounce right back up again. I think the expectation for a V-shaped recovery, just by the nature of the length and duration already, have now kind of evaporated, and folks are looking at a longer term sort of downturn in prices and stabilization, probably at prices slightly lower than folks expected.
Okay.
The other impact that's hit the U.S. that wasn't the case in prior downturns is we've become such a big producer. In the past, when the price of oil went down, the production affected the guys over there. And what's happened here is as our production has increased and technology has increased and fracking, for example, has become more prevalent, you have a whole big piece of oil field services companies that really doubled down and said, hey, we're doing not just better because prices are higher, but we're going to build businesses around this. So the depth of the impact on other parts of the economy is being felt greater at home this time than it has in the past.
And the one thing I'd add is that there's a difference when a crash happens, whether it's demand-induced or supply-induced. So in 2009, we had the global financial crisis, and oil prices dropped precipitously because global oil demand contracted 3 million barrels a day like that, okay? And that was a demand-induced drop, which is easier to correct because once demand the economies got back on their feet, that demand went right back to where it was. It wasn't supply-driven. If you look at 1986 and you look at 1998, 99, those were supply-driven. And this downturn was supply-driven. All three were essentially the same dynamic, and that is Saudi Arabia, and primarily Saudi Arabia, but the other OPEC leaders that had spare capacity decided that they were going to protect their market share. And when they decided to protect their market share, they had overproduction relative to demand, and that caused the price to go from the upper ceiling, where supply comes on and demand goes away, to the bottom floor, where supply goes away and demand comes on. And so that shift from the upper to the lower end of the bound is exactly what happened because it was a supply driven. Now we're in a point where demand has to grow to absorb that surplus. And so that's kind of where the market is realigning right now.
Got it. So Andy, taking into consideration oil and gas explorers and producers in particular, how are they being affected with the downturn?
I mean, obviously the capital isn't there. The capital that they anticipated they would have easy access to for the next few years just has kind of evaporated. And obviously, at these prices, it's difficult to just drill your way out of the problem. So each of the participants, particularly in the smaller ranks of the E&P companies, they really, they took the obvious steps. They started to cut capital budgets. They started to lay down rigs. That's the first lever you can pull to try and maintain your liquidity position. They then tried to take in additional investments in a way that would extend their runway. So I think in the spring of last year, we saw a lot of second lien deals being done, where folks were trying to invest in the capital structure somewhere between the traditional borrowing-based lenders and the unsecured notes, to the extent that was the typical structure. The next thing they started to look at were obviously selling non-core positions and trying to sell out of acreage. The problem there is you had the sort of catching the falling knife syndrome, which is no one really was sure whether we'd hit bottom or how far this was going to go. So it was difficult to sell your assets at the pricing that was being offered by buyers because buyers weren't sort of coming in with blowout offers. And then finally, the E&P companies have begun to look at more drastic solutions. So certainly over the last 6 months or so, we've seen a significant uptick in companies, either because they're forced to or because they're voluntarily exploring a true restructuring scenario. And in that circumstance, they're looking to do everything from kind of renegotiate contracts and ultimately go into a voluntary filing where they have an arrangement with their creditors, or they're just looking to sort of go straight into a pre-pack or a pre-arranged where they equitize the entire capital structure. And on deals such as Magnum Hunter or Swift, for example, those were two of the first out the gate where it was complete equitization of the capital structure, which is obviously a huge development for the space.
And I'd also add that obviously, as Andy said, we're into an industry that has to deal with a lower commodity price. And so you have to dramatically reduce your cost structure in order to survive. Those companies that don't have assets that lend themselves to being able to drop their costs below to a point where they can make some operating profit, they're essentially in liquidation. Okay, so those assets are in fact at low prices are liabilities. So if the bondholders take them back, they're going to take back an asset set that needs to be fed cash in order to wait for the downturn, for the downturn to end. Importantly, though, and I'll end this comment on a positive note, because the E&P industry has really done amazing things in this country, where the Middle Eastern community completely, in my opinion, misunderstood the extent of American ingenuity. And the unconventional shale revolution was not brought to you by the major oil companies. This was brought to you by the thousands of independent oil and gas producers who were really working on really tight rock and trying to find ways to make it work. And so now everyone thought the cost structure was kind of $60 or $70 below which you're really going out of business. And now we've been able to drop that into the 30s and 40s, which is really amazing. That what the new techniques and the new pressure to really get your business right has been led by American ingenuity. And that's been impressive. So it hasn't helped matters. You don't make that much money at $30 or $40, and most of the basins around the United States don't make economic sense on a full cycle basis near those prices. But at least you can stay alive covering your operating costs. But that wouldn't have been the case 3 years ago. People wouldn't have guessed that. So I'm hopeful because of what this industry has been able to do with really great independent oil and gas operators applying good old-fashioned business skills and using new technologies where they can.
And I think also just to pick up on one point that Ken made, because maybe folks are less familiar with this, not all basins are created equal. If you're drilling in the Permian, that's one thing. If you're drilling in some more high-risk areas or more challenging areas from a development perspective, that's a different situation, and it can be a higher cost to obviously develop there. The other thing is, in many cases, it's not just the oil price that's relevant. Obviously, natural gas is a critical point, and it shouldn't be lost that the natural gas price drives a lot in the U.S. When it comes to not only the E&P sector, but also, for example, in the utility sector right now, which has been very negatively impacted by natural gas prices.
Definitely. Wow. Okay. So Wayne, can you comment specifically on oil services companies and how the downturn has trickled down to affect them?
Sure, and the trickle-down is an interesting dynamic because the operating companies, the oilfield services companies, really are responding to a customer need. And as Ken and Andy have talked about, the E&P companies, the exploration companies, are driven by commodity prices, and it has the characteristic of a financial play. And where that affects the oilfield services companies is these are the guys who are providing the rigs, these are the guys who are providing the trucks, all the infrastructure, the repair services, whether it's the divers to repair offshore wells or the guys who are hauling the chemicals away from the fracking. And they really have their demand for their services are driven by what the E&P guys want to do. And these companies are all different sizes. In some regions, they are entrepreneurial, smaller guys who have a fleet of trucks. In other places, it may be somebody that has 16 rigs that today are stacked on the side of a highway in Oklahoma. So they are not on the front line making their decisions, and there are many players in this sector that, during what I'll call the boom times recently, overextended themselves, particularly in capital expenditures. They bought too many trucks, they bought too many rigs, and now the debt service continues and they don't have a partner to help them out, and that's where we're seeing a lot of hiccups and a lot of failures among oilfield services companies.
And that's the nature of the beast. I mean, oilfield service companies, I think, expanded during the height, but they weren't doing that just because. They were getting calls from the E&P companies saying, we need more horsepower, we need more frac crews, we want to shorten our cycle times, so bring us the supply. So against those orders, the oilfield service industry will always staff up. And then when those orders dry up, then they're left with the surplus equipment. And so then the pricing goes, kind of goes with it. So, I mean, I think it's just the nature of the beast. And I wish there was a way around it, but the oilfield service business is an exaggerated boom-bust, kind of on the fringes of the normal cyclicality of the oil and gas industry. And so I think that the oilfield service industry has been a big driver of this innovation also. So the better oilfield service companies have been the ones who've been able to be innovative and do more with less, and they're the ones that have been the most healthy. And I think when we come back, they'll be the first ones back. So I think that there's some healthy creative destruction going on. I mean, it's painful, but I also don't think that that people like to blame the oilfield service industry. They added capacity at the top of the market, and they should never do that. I mean, they weren't just making it up. I mean, there was real activity. There was real rig count. But when the rig count drops by 60% or 70% in 24 months, there's only so much you can do.
So the better capitalized companies, the larger companies in the space, larger oilfield services companies, will be in a position today, and they are doing this, of buying out the smaller competitors as they fail. So you're going to have a concentration. So as Ken said, when it comes back, you're going to have more bigger companies, and it'll take a little bit of time for the smaller, more entrepreneurial guys to recalibrate and get back in the market.
Okay, so focusing back on the price drop issue, how are midstream companies being affected and in turn working against the issues they're facing?
I think, so the midstream sector, until relatively recently, was somewhat robust. I think they were insulated to a certain extent because many cases they had take-or-pay contracts, minimum volume commitments, really mechanisms within their contracts that protected them from the upstream distress. However, it was only a matter of time before ultimately it spilled over into the midstream space, and we've certainly seen that. I think there was a large midstream large midstream company filed yesterday, which I think folks will be aware of. And then we've since seen, and I think you're going to come on and ask about it, the Sabine decision, which obviously is very relevant to the midstream space. So I think overall they've probably not seen the worst of it so far, but it's definitely beginning to spill over into that sector. I don't know if you disagree, Ken.
No, I think the midstream business, it's a different business altogether. You peel away the layers, and you'll find different pockets where you have new supply, you have specific bottlenecks in the Northeast where there could be real midstream opportunities because there's need for more processing and more takeaway capacity coming out of the Marcellus and the Utica. There are places that are overbuilt, that are highly competitive. Those places are going to have as much trouble as the E&P customers, as their E&P clients will have. So I think it's kind of case specific, but if you don't have a growth, and you're just sort of maintaining production, then those midstream companies that were relying on growth and that the stock market was pricing in a growth multiple, that's obviously going to be some air that comes out of that balloon. So I think we're seeing it. I think for the most part, the midstream companies have longer runway for the most part. The oil and gas companies have serious reserve declines. I mean, all oil and gas wells decline, and the unconventional resources decline a lot faster. So you're seeing the maturities and the bank revolvers and all of the redeterminations that happen twice a year. Those are zeroed in, laser focused on this decline rate. And for companies that are underfunding their CapEx, they're not able to catch up. And that's where your debt stays flat and your reserves decline. It's only a matter of time till those lines cross. The midstream companies, most of them have a longer runway because they have a diverse suite of clients, diverse suite of operators. They generally had longer dated debt structure. So we'll see what happens. I'm thinking that they'll ride out the storm for the most part.
Definitely. So, Andy, going back to you, you brought up the Sabine case. Can you give us a little background on that and how it's actually affecting exactly what we're talking about, midstream companies?
Sure. So the Sabine case, I mean, basically the midstream upstream paradigm for many years has really revolved around contracts that run with the land. It's a legal term of art. So basically what it means in layman's terms is that even if you sell the acreage to someone else, the contracts will continue to bind the acreage. So if you're a midstream company and you've got a contract which says, upstream producer has to put this amount of hydrocarbons through or pay me as if they have, that obligation is going to continue to follow the land. In the Sabine case, our firm actually argued that effectively it wasn't truly a contract that ran with the land. It was actually just a services contract. And the impact of making that argument is that if the upstream producer goes into bankruptcy, then effectively they can reject that contract under the bankruptcy code. So the theory that underpinned the midstream company's revenues, that those contracts would always be there, kind of disappears. And the reason it's particularly relevant now is in many cases the pricing on these contracts was set when the price of oil was a lot higher. So these contracts are very onerous on upstream companies right now, and there are many upstream companies that if you told them you can set aside all your midstream contracts and renegotiate tomorrow, they would absolutely take that in a heartbeat. So in Sabine, it was in the Southern District of New York, the bankruptcy judge agreed with our analysis that basically it was a services contract and allowed Sabine to potentially reject all of their contracts with the midstream operator. What that's led to is obviously a number of copycat suits by quite a few of the upstream E&P companies that are either in bankruptcy or about to go into bankruptcy. And it's caused panic in the midstream space. The question we get most, I think, after the ruling is really how widespread does this ruling go? Will it really be upheld? And the advice we consistently give to folks that ask us that question is don't take it too far either way. On one side, I certainly wouldn't say that it's absolutely going to be followed throughout the country, because at the end of the day, it was in a bankruptcy court, although it was applying Texas law. It wasn't in Texas state court. It is subject to appeal, and other states would have to follow it. And then there's the very real practical limitation on that argument, which is in the Sabine case, they had another option for getting the hydrocarbons out. They could truck the hydrocarbons out. In other circumstances, E&P companies won't have that flexibility or that option. They will have to use the gathering system. So don't take it too far and say it's going to be followed in all cases and destroy the midstream sector. I don't think that's right. Equally, I don't think you should take it too far the other way. There are certain law firms out there who are advising their clients, forget about the Sabine case. You know, if it gets to a Texas state court, it'll be completely ignored, it'll be overturned, et cetera, et cetera. I don't think that's right either, and I think folks, particularly folks that are investing in midstream, have to be aware of the decision and aware that if it does get followed, it will have a significant impact. But I think overall, the commercial takeaway from the decision is not so much whether it will be followed legally or whether it won't be followed legally, it's that it will lead to negotiation. Because right now, if an E&P company goes to its midstream provider, if they'd gone to them 2 weeks ago or before the Sabine decision had came out and said, we're going to, basically renegotiate these contracts, the midstream company would have said, no, you're not. You've got a binding agreement and you have to continue to abide by it, even if you go into bankruptcy. Now that discussion is very different. So if an upstream company goes to a midstream company and has the same discussion today, and the midstream company responds and says you have a binding obligation, the upstream company is going to say maybe, maybe not. And oh, guess what? We've got lawyers that are willing to go in and roll the dice in bankruptcy court to reject these contracts. And that inevitably will lead to more negotiation between midstream and upstream over the coming few months, which in and of itself will have an effect on the midstream sector, because folks that thought they had ironclad contracts now are probably a little less certain that that's the case.
So what types of deal-making opportunities do you see coming out of all of this?
That's a great question. I think one of the things we're looking for is whether it will cause integration between midstream and upstream again. In many cases, the midstream companies were spun out from upstream enterprises. It used to be one integrated chain, and the E&P companies often spun off their midstream. It's possible that you'll start to see vertical integration between the two again, and they'll start to put the midstream facilities back together with the upstream. If you take a case where the contract is rejected, you could be sitting there with a midstream facility that's basically just going to rust unless the upstream producer has some incentive to use it. And equally, if you put it on the other side, if the upstream company can't get out of the contract because it does run with the land, then often it's just not economic to use that midstream facility, and the only person that would really benefit from that acreage will be the midstream company.
Got it.
So we may well see some integration there. Other than that, I think that there's a strong possibility that you'll see significant dislocation in the midstream space if this ruling is followed widely, and you'll have the same M&A activity you see in any dislocated industry, where folks will start to either consolidate or go through bankruptcy or divest.
It'll be interesting to see how this plays out. I think that Andy's correct. What it'll cause people to do is sit down at the table and talk, and that's the natural thing that should happen. Because if your midstream commitments are so high that it makes your drilling uneconomic, but if your midstream came down to sort of a more rate that's commensurate with the price regime we have, then you could develop more of your field. Then it behooves the midstream company to be a little bit more flexible, or else they really do have the same wasting asset that the E&P company has if there's no new volumes brought into their system. So this feeling that the midstream companies are going to sit there with this lofty minimum volume commitment or some pricing, and they just hold firm, and they can stare at their one customer and watch their customer go bankrupt, it doesn't help them at all. And that's their best asset is this liability that the other guy has. And that's not a good natural state of affairs. So I'm, again, more hopeful that I think what you'll see is people looking at the state of play and saying, look, we need to talk about a global alternative that allows us both to be healthy, instead of one to be healthy and one to be sick. And when the other one's sick, it doesn't matter, how healthy the midstream company is, because they might not be able to perfect their claim.
Tough. Okay. So Wayne, turning to you, it's clear that bankruptcies have been on the rise this year, and in particular pre-structurings where companies are hiring advisors to come in and come up with a set of options for them. Do you think that we'll see a lot more Chapter 11 in the coming months? And if so, how widespread might it be?
Sure, I think there's going to be a lot of widespread Chapter 11 activity, but again, we have to divide it between E&P companies and oilfield services companies because the reasons and the dynamics are very different. Chapter 11 is a tool. It doesn't mean a company's going out of business. When people say they went bankrupt, it doesn't mean what it used to. So on the E&P side, it's used as, again, a tool of corporate finance to restructure a balance sheet and take some debt obligations, equitize them, rebalance, and frequently some of the players, whether it's secured note holders, unsecured note holders, they bought in at discounts. So there are cases where people hold debt at a certain face value, and then it becomes a valuation fight to restructure it. So valuation becomes very important and something that happens in Chapter 11. On the services side, it's more of a traditional business where you may do what's called a Section 363 sale, where you're going to sell the assets of a business and sort of use the bankruptcy code as a wind down and return capital as best you can according to the capital stack. So very different reasons, Chapter 11 being used as a process, not an end game. And to your point, the pre-structurings or the pre-negotiated or the pre-arranged, these are all tools where if you're going to have a fully pre-arranged or pre-packed bankruptcy, you're going into Chapter 11 really as a wash cycle to stay pending litigation and shed certain liabilities and come out the back. Even though everyone knows going in what the economics are going to be like, it's a way to cleanse the balance sheet in the business and move forward.
That sounds really elegant when you say we're going to equitize the business, and it's really the operations are going to be there. As an equity holder, if you go through Chapter 11, you get wiped out generally. So there's nothing glamorous about that. It's a violent process for the equity as you shift value and you shift ownership, from the equity to the creditors.
But that happens whether you go into bankruptcy anyway, right?
Of course.
If you stay out, you're probably going to wind up as the equity guy in the same position. But the business as a whole, for all the constituents, that's the reason for going through that process.
Now, I would add, though, back to the macro a little bit, because I think this is an interesting point. I hear a lot of people who naively say the U.S. is the swing producer and we can turn on like a light switch, these unconventional shales will come right back on again. These bankruptcies are intricate, big, time-consuming, expensive processes. Mm-hmm. And if you look at the major independent oil and gas companies that are in trouble right now, many of them were the engines of growth going back 2 and 3 and 4 years. And if they wash through bankruptcy for 18 months, 24 months, just because prices may rebound doesn't mean that they're going to be awash with cash and stand up 30 rigs and get going again. Mm-hmm. I mean, the people who own them are not the natural owners. Now it's the banks that may own them, or the second lien guys that may own them, or the unsecureds may own them, or there may be a combination thereof, and they're trying to sort it all out, what the governance is going to be, and they got to go through a capital budget cycle and maybe management changes. And so the world turns, and these companies are going to be flat-footed for a while. So if you look, and I don't want to name names, but they're out there, the big engines for growth, many of those are the companies that got caught when the window closed and they had over-levered balance sheets and they have high decline rates and they're kind of stuck. That's going to be hard to turn that ship around right away. So I think that is sowing the seeds for the rebound, and much of it will be because of the nature of these bankruptcies.
Yeah, I mean, I would say back to the sort of, and I totally agree with everything these guys said, I think back to the more specific side of things, there's really 3 factors that are contributing to additional bankruptcy beyond the macro points, obviously, that this has lasted longer than we thought. If you look at who pushes a company into bankruptcy before it has to go in, before it's really hit the liquidity wall, it's really management and it's the old equity, and they have to decide that they want to sort of go down that path and put it into generally voluntary Chapter 11. On the management side, the two big factors there. One, there was kind of a stigma attached to filing for Chapter 11. I think to a certain extent that's beginning to disappear as more companies go through it. And then the second huge element is for many of these management teams, they're sort of coming to us and saying, look, we can do a rifle shot exchange offer, or we can do some kind of liability management to extend our runway out 18 months. But then what? Because they're still saddled with, in some cases, a capital structure that can sustain $700 million of debt, and they're going to have $4 billion after they do an exchange offer or some other kind of liability management. And in many cases, the management teams are now getting to the point where they say, look, we would rather just go in and get it over with and come out of this thing healthy and have the ability to take advantage. There's a couple of E&P companies will come out in the next month or so. They've already gone through the process. And they're going to be coming out debt-free and able to take advantage of some of the dislocation. And management teams are looking at that. And then the final point, the third factor is really for old equity. I think the perception very much is, and it's pretty close to the mark, that really Chapter 11 is a wipeout for old equity. I think two things that slightly change that, but not massively so. In recent Chapter 11 arrangements, we've seen a new structure beginning to develop where you equitize the entire capital structure and you also give a tip to old equity. So there's one out there right now where effectively the old equity is going to get 4% of the post-emergence company, roughly, call it 4 or 5%. And then it's going to get warrants, which are out of the money and probably will never get in the money, but they may do. And it allows the old equity to basically continue to ride the option, effectively, ride the old equity option. Now, I wouldn't overstate that because I think Ken is completely right. You're most likely going to get wiped out, but there is still a possibility that you can ride that option. And certainly after this, January 1, when two of these went in and we began to see the structure emerge, I mean, I think we were retained by about 15 E&P companies in 4 days after January 1st. And that was because old equity suddenly realized, look, we're not going to get out of this period. Let's try and go in now when we can still potentially get some kind of option upside on our old equity investments. So I think all those factors together means I do believe we'll see a lot of Chapter 11s, call it in the June to September timeframe is my guess.
Got it. So staying in the topic of bankruptcies, both bankruptcies and debt restructurings could trigger taxes for investors of MLPs, which, to note, has been popular for the oil and gas industry in recent years. What's actually being done to prevent this from happening, and do you think it will tarnish interest in these types of vehicles?
Yeah, I mean, it's obviously a very complicated subject, and but it's a very relevant one right now. I mean, I think this problem has always been there. It's just never really hit the consciousness. And effectively, the issue is obviously that for MLP public unit holders, they can be told that not only is their investment at zero, it's less than zero because they're about to get a big tax bill. Because cancellation of indebtedness income in a partnership pass-through structure passes through to the partners. It doesn't get caught. If you've got a C Corp, it obviously gets trapped at the C Corp, and there's a bankruptcy exception in the bankruptcy code, which, when you actually go through Chapter 11, extinguishes the code effectively. So folks have been looking at this issue now, and I think they've been very aware of it for the last 3 or 4 months. There are solutions out there that can fix this. I know there have been articles in the New York Times and Wall Street Journal about the problem. There are working groups that have been formed. I know certainly our firm, the head of our tax group, got together with the big 4 accounting firms, call it 9 months ago, and started to work through solutions. I think that the advice that many companies have received so far is that the best solution is, or the only solution is to tick the box and become a C Corp. That's actually not great advice. It's actually probably of the 5 major solutions, that's probably the worst because you destroy the tax basis for your creditors. You can never go back to becoming a partnership after you become a C Corp. And effectively, it's generally a very messy process. It's not entirely clear that it won't be challenged by the IRS in any event. There are other structures out there which work. I think you just saw Lynn file publicly that they're going to allow public unit holders to exchange for Lynco stock, which is obviously the C Corp that floats above the Lynn MLP. There's another 3 or 4, one in particular that may lead to more M&A. If you invest in a company that has significant CODI and you have NOLs, then you can basically be compensated for your net operating losses coming in to solve the CODI issue for old unit holders. That's one that I think will gain a lot more traction. And it's already beginning to lead to auctions where bankers are going out to seek NOL investors to come in. So I think you'll see a number of structures aimed at solving this issue. There's probably about 4 or 5 of them out there. There's no silver bullet for any one pass-through, but it will be something that will get solved over time, and I think it's a bespoke solution in each circumstance. As to how it's affecting it, I mean, I think some people will tell you that certainly in the upstream space, there's skepticism as to whether upstream MLPs will continue to be as widespread as they were before this downturn. I think in the midstream space, it's still a vehicle that I think makes a lot of sense for financial investors, because those vehicles are obviously vast consumers of capital, and I think it generally has worked fairly well, but we'll only be able to really assess that once we come out of the downturn. I don't know if you disagree.
I would agree with your assessment. I think that the MLPs are a viable strategy for the right kind of asset, and where the market missed it in some ways were companies that called maintenance capex. They understated their maintenance capex, but these are, this is a creation of the downturn, and when you have leverage in a vehicle that pays out dividends, and commodity prices go down, I mean, something's got to give. And so you end up with these issues, and I think what will end up happening is that you'll end up with better structures and you'll end up with a better product as we come out. And then there'll be people who say, wait a minute, if I started an MLP when oil's at 30 and it goes to 70, okay, now I'm back in my increase again, right? So it may not be a bad structure. I don't want to throw the baby out with the bathwater. It's just a question of the cyclicality of it and how much it grew at the time and what that time was in the cycle. And we'll work through it again. I mean, we've seen this movie before, and there's nothing wrong with the structure itself. It was the way it was applied at the time it was applied. So we'll see.
So staying within that mindset, Wayne, what do you think it's going to take the oil and gas industry to mend? And if it can, when do you think we're going to see this happen?
Well, we talk about what it means to mend. Let's start with getting back into equilibrium. So you've got cash coming in the form of revenue, whether that's revenue from oil prices to the E&P guys or the E&P guys paying down to the services guys. You've got cash coming in, and you've got to right-size that with your obligations. Your obligations being really twofold: one, operating costs; two, financing costs. So what's happening is the lenders, first of all, are stepping up and recognizing this disequilibrium and taking adjustments to their balance sheets, thereby lowering the financing costs. And then the operating companies, the services companies, are re-looking at their costs, their operating costs, as well as their CapEx plans. And so what happens is, if oil stays low and then increases, you're going to have a crossover point where the balance sheet has been right-sized, the operating costs have been rationalized, and at some point it catches the wave as the revenue, the cash coming in, comes back to normalized levels. That's what we're talking about mending. Then, of course, if you have outsized returns, if it continues going up, you're going to be back into the cyclicality and the outsized returns. With regard to when, I think over the next 6 to 12 months, the first part of that is happening. I can't pay my bills, so I have to cut my operating costs, and the banks have to sit down with me and fix the balance sheet. 6 to 12 months to be in the right place, and then the rest is going to be what happens with the futures curve on oil.
Okay. Do you want to jump in?
The market's correcting. Demand is going up and supply is going down, and so from in that respect, I think that we've definitely bounced off a bottom, and we're into the recovery. The question is when, and we'll leave that to the market.
So let's stay with this positive mindset. What
you.
type of M&A deals do you guys see actually happening or on the horizon as things will improve, hopefully?
Who do you want to take that?
Andy, do you want to jump in?
Sure. I mean, I think I'd put it in 2 or 3 buckets. I think right now we're seeing a lot of M&A activity where they're looking to solve a capital issue. So you're seeing a lot of preferred deals. We've probably got 7 or 8 preferred deals right now in the office that have varying chances of success. I think you'll see a number of rescue loans and a number of sort of loan-to-own type structures where folks come into the debt with the full intent of it going through Chapter 11 and ultimately owning the company. So that's sort of one bucket of M&A activity. I think the other basket would be consolidation with some of the strategics. We haven't seen a vast wave of strategic deals so far. Mm-hmm. And even on the PE side, although we've seen some smaller transactions, I don't think we've really seen the full weight of the PE firms. I mean, there are some PE firms, I'm sure you're going to ask about this in a second, but there's some PE firms sitting out there with huge war chests. Mm-hmm. And I think they've really been in the same spot as everyone else. They don't want to buy when the commodity's still falling. They want to buy when it hits bottom and then ride the upside. So I think as it becomes apparent that we're basically going to see the return, I do think you'll see PE firms going in, both through traditional methods like buyouts and also through this loan-to-own type strategy.
And I'd say that the loan-to-own strategies, the refinancing, using the balance sheet as a way to capture assets has typically not been the bread and butter of the private equity industry. Okay, that's really much more of a hedge fund, credit-driven animal. The private equity industry has really grown up, and what we helped invent in 1988 was a ground-up backing management teams who understand an area, who understand the value, forgetting commodity prices, but know how to make money in that area. And so which is how we approach the business, and we have great companies run by great people who are coming to work every day and looking for value in their particular area. If there happens to be a distressed seller of a quality asset in that area, then hey, we'd be a natural buyer for that. But absent that, when you look at the market today, there's very few quality assets that are in distressed hands. Most of the quality assets, as you said at the very opening, have been able to tap capital markets even if they are a little bit skinny, have had good runway, have had other options. And so if they are sellers, they're not distressed sellers. I've never seen an asset that sells for distressed prices. I may see it go at a distressed moment, but generally speaking, there's more than a few people who are interested in it, and so the price will get bid to a natural level. So the name of the game for private equity is about assembling quality assets around quality people. And that game hasn't changed. So we need the natural relationship between buyers and sellers to exist, where sellers are rationalizing their portfolio, where they're moving out of one area because it's just not strategic for them anymore, and going into another area. And for somebody who might have a lower cost structure or maybe just smaller or in their life cycle, are willing to take on that asset at that moment in time, there's this natural reason for the sellers to sell, and there's a natural reason for the buyers to buy. The buyers aren't trying to pick somebody off at the bottom, and the sellers aren't trying to do something distressed. And that's really where private equity has played so well and been a growth engine. And it's more the hedge fund credit mentality really swooping into a particular target and saying, this is what I want to go after because I like that asset, and look at that balance sheet. I can use the balance sheet by buying this debt at a discount and washing it through bankruptcy, and then I can grab the asset. I'll worry about management later. Do I like the assets? I'll worry about that later. I mean, we kind of focus on the people, and the people lead us to good quality assets, and sometimes the sellers are more distressed, and sometimes they're not, and we'll just wait and see.
What will be fascinating though is watching the intersection of what Ken's describing with the distressed buyers that are coming into the credit, because in many cases the ones that do go through Chapter 11 will be owned by distressed investors that have no interest in holding for the long term. I mean they're truly sort of coming in, they've bought in at a low valuation on the debt, and ultimately from their perspective they'll want to trade out of it. They're traders. And that will be interesting to see whether it's private equity that comes in and basically takes those assets away from the distressed investors once it's gone through Chapter 11, or whether it's more strategic players that begin to consolidate at that point.
And in 1999, 2000, and 2001, we saw this phenomenon again, where people bought the debt because it looked cheap on an NAV basis, and they went and bought the debt. 2 years later, with the decline rate, they ended up saying, where's our assets? And they tried to sell them, and they realized it was a very bad market for them, because they weren't great assets. Mm-hmm. And so not all assets are created equal. Even within these shales, there's high variability. There's sweet spots and there's areas that are fringe. And if you're playing the fringe, you basically have an out-of-the-money price option. Because if prices don't turn around, there's going to be very little market for that. So if you bought the debt to capture that, great, so you captured it. You better be right on your timing, you better be right on your asset call. So I think that there's a lot of analogies on this, and that's why we stood down for the most part in playing the credit game in the first quarter of last year, where so much money came in, anticipating it's a V-shaped recovery. That doesn't happen when you have supply-driven downturns. It's when you have demand-driven downturns, as I said. And so unfortunately, we've seen a lot of that money wasted, and it shouldn't have been, because people really should have been more patient and really more discerning about the asset quality, because that's where the game starts, in my opinion.
Yeah, the paradigm that you're seeing in terms of what's motivating the Chapter 11, though, is being driven a lot more today by the hedge funds and the securities investors, as opposed to the private equity guys who you say look at the management. Everything from due diligence to investment decision-making horizon is different, making a Chapter 11 process much more conducive for the financial engineers than for the guys like Ken who want to find that management team and build value over the longer term.
And I think certainly, there have been some surprising elements to this too. I think everyone thought the market was going to be awash with assets and A&D deals. That just hasn't really happened. And I think one of the other sort of contributing factors there is with these hedge fund investors, they're sort of looking at it and they're saying, we're probably going to go into Chapter 11 in any event. So why would we now sell our crown jewel asset at a low valuation and then go through Chapter 11? Let's just hold on to equitize and we'll come out of this thing on the other end. So there's been less M&A than we expected, but I do think there's going to be more over the next couple of years.
So Ken, why do you think foreign buyers have been so silent recently, and when might we see their interest peak again?
Well, they're silent now because they were quite loud over the last 4 years. And they were very aggressive participants in major industry joint ventures, primarily with the large independent oil and gas companies, and then some that bought directly. And they were generally ill-timed, they were generally ill-structured, and as a result, they've lost on both counts. They've lost because the deal was poorly structured and they had poor quality assets they may have been chasing, and then commodity prices go down and their economics suffer on top of that. So I think right now the foreign buyers are more licking their wounds and understanding what they did wrong, and if they still own the assets, how to reconcile it from an operating standpoint. And there are some good quality assets that remnants that have been left, and they're foreign owned, and they're equitized, and they have to realize they have to operate it. And it's operating in a challenging environment and dealing with things like corporate culture and U.S. regulation and how do you downsize. I mean, these are challenging business 101 topics, and it's not just a commodity price play. I mean, I can't tell you how much time I spend talking about commodity prices when I do stuff like this. And in our daily life, we don't talk about it very much at all because it's about running a good business, which means hiring good people, focusing on good long-term planning, on good balance sheet management, on good asset development. And commodity prices are what they are. And I learned a long time ago that you do not invest in this industry reliant upon commodity prices. You will only be disappointed if you do that. And so that served us pretty well. But people who think that it's some sort of just a proxy for commodity prices are playing a real short-term game. And if they don't call it exactly right, they're going to be disappointed. And if they do call it right, but they miss the timing, if that decline curve catches up and you only have half the volumes left, it doesn't matter what the prices are.
Definitely.
So that's where we are.
So going back to kind of what we talk about private equity firms, they back a lot of management teams. They did back a lot of management teams through the downturn, and they're starting again to pick up distressed assets and those out of bankruptcy. Why did it take so long, especially given how much dry powder they have on hand?
I think, look, I think it goes back to many of the things Ken's saying. I think on the commodity price side, they definitely didn't want to invest as the commodity was falling, and that would be dumb. But I think more important than that really are the factors that Ken's talking about. I think private equity in this space has really developed massively in the last, call it 6 to 7 years. I mean, I remember back in kind of 08, 09 when the bulge bracket PE firms were really beginning to get into oil and gas, and there was a lot less sophistication as to in their investments. They were certainly willing to do LBOs. They were willing to kind of dive in. They were less. They were a lot more resistant to kind of holding working interests or backing management teams to go out and do development plans. At this point, they've kind of crossed the Rubicon, and now they're very sophisticated investors in this space. And I think, just as Ken has said, beyond the commodity price, they're looking for the right opportunity. And I think they're looking for the right management team, they're looking for the right set of assets, and they're quite selective at this point. Would the PE firms that I deal with on a daily basis, would they like to have deployed more capital in the last 2 years? Definitely. But equally, they don't want to be sort of making big bets on a rebound and ignoring the fundamentals, which are good assets, good rocks, and a good management team. I think that's the main reason for it.
So staying on the topic of private equity, are there any new type of deal structures coming out of them, and as they're helping companies through the downturn?
I think it's gone in phases. So, in the spring of last year, as I said earlier, we saw a lot of second lien deals. So PE firms were looking to come in. Initially, we saw a lot of investments in unsecured bonds by PE firms, as well as the distressed investors. That was kind of ended when some of them began to go into formal proceedings, and in many cases the unsecured bonds got wiped out. Then we saw the phase shift to second lien investments. Again, there was a lot of money lost because I think folks fundamentally didn't understand the extent of the downturn, and also bluntly, they didn't fully understand the way they could be layered in a capital structure, and that the fulcrum, frankly, could go as high as the first lien borrowing base facility. And in some cases, even the borrowing base lenders are finding that they're, maybe under collateralized. So that was the next phase. Then we've seen a lot of these preferred investments. These are not new structures, but they're just being deployed at different times during the cycle. As for what will come, I think ultimately we'll revert back to what we've seen in the past. They'll back management teams. I do think that you'll continue to see preferred investments and other alternative ways of deploying capital. The Drillco structure, which was very popular, 2-3 years ago, that's beginning to come back into vogue, although it's been largely dead, I think, for the last 6 to 12 months. There's been a lot of term sheets out there, but none of them actually got done. And so there are other structures out there. I think we've seen all those structures, but they'll just be deployed at different points in the cycle, is my guess.
And let me add that the driver isn't just the cycle; it's the type of asset. Okay, if you have an asset that is a net consumer of capital, then financing that in the high yield market with interest only for 7 years is not the right way necessarily to do that if you're consuming capital. Because then what happens when you get out to 7 years and there isn't a refinancing? Okay, if you have an asset that is lower decline, where you can grow production by spending less than your free cash flow, then now you have a growth asset. That one can stand a Drillco structure or a credit-like structure. It's all right. So I think that the market has always been discerning. But back to the very top of this conversation, what we saw when oil was at 100 is everything worked. Okay, everything. So apply all the structures. It kind of doesn't matter what the asset really deserved. Apply it all, and see what happens. In different markets, different people push different products. Now, I think we're going to come out of this much more healthy, back to where we were again, where we say, all right, these are the people who understand the assets, and you capitalize the asset properly. And if you have a growth asset, you want to over-equitize it. Okay, if you have a harvest asset, you might be able to put it on more leverage. And again, that's Finance 101 stuff. It's what we've been practicing forever. And so when we see all the new entrants come in and do cockamamie things, we kind of say, all right, let that happen, because it's not going to end well. and now we're seeing it.
I think the other interesting aspect is whether there's going to be more opportunity for private equity, because certainly for the next 6 months or so, 12 months, the capital markets that were there 3 years ago are just not there anymore. And for many industry participants on the strategic level, it was like crack cocaine. You just went to the equity markets or you went to the debt markets. They just continued to fuel it with public money or other forms of investment other than private equity. They didn't really need private equity to the extent they probably need them in the next 6 to 12 months. So I think that'll be another interesting aspect of this, is whether we see far more widespread private equity activity because there's less access to the traditional capital markets.
It'll be nice to be needed.
Yeah, exactly.
That's good. Thank you.
We always needed you.
Yeah. You forgot about us for every long time.
So Wayne, are there any kinds of new investors that we're starting to see in this space, possibly just looking for a bargain?
Sure. Well, investors take on an interesting note. What is an investor? One of the things we're seeing, particularly with operating companies, is banks, secured lenders who are in the position, who have said, you know what, we don't think when this gets into a Chapter 11 we're going to get enough value when we sell the assets. We are the fulcrum. We're going to credit bid a little bit higher. Maybe we have a hidden management team behind us that's different than last week's management team. We're going to buy the assets. We're going to let them sort of run with it for a little bit, because we know that the value of these assets down the road will be greater. So the bank has the built-in capital base because they effectively have already made their investment. They'll buy them through a credit bid and they'll ride it out and come out the back end and capitalize that way. So that's the services side. And then again, what we're seeing on the E&P side is with the distressed investors who are buying bonds at a discount, in some cases a huge discount. You might have somebody buying something at 10 cents and then pushing the process to equitize them, because they'll be very happy with a 20-cent recovery, whereas the bondholders, particularly retail bondholders who bought in at 100, really are taking an 80% haircut, but the distressed guys may be taking a 100% return in a very short period of time.
Yeah, I would totally agree. I mean, I think the distressed investors are the big development. I think when we started this whole downturn, it was kind of interesting because you had distressed investors that really didn't know much about energy that were trying to get into the space, and frankly, you had some energy investors that didn't know much about distress that were trying to get into the space. I think what's been fascinating during this downturn is the speed at which the distressed investors have gone up to speed. In many cases, some of these distressed funds have added energy teams that have grown fivefold since this commodity downturn happened. And I think that's adding a new layer of participant to the market that really weren't there in any great number and before this all started.
So we do have an audience question. Before we shift gears there, I'm going to put all of you on the spot. Where do you predict oil prices will be at the end of this year, the end of next year, even 5 years from now? Go ahead.
Do you want me to go first? I think if you find anyone that will tell you with certainty where oil prices are going to be, this time next year, certainly in 5 years, then you probably shouldn't give that person much of your money, because I think it's
You're not answering the question.
I think it's like throwing darts at a dartboard. And
You're a bankruptcy lawyer. Go ahead, get on a limb.
I'm an M&A lawyer, I promise. I'm definitely not a bankruptcy lawyer. That's just my hobby. But no, I would say, I think the smart money from what I've heard, and again, this is more in Ken's realm than mine, is that probably by the end of next year, we start to return to something more normal. What normal is, I'm not sure anyone's willing to be tied down on that. But I've heard enough predictions over the last 2 years as to exactly when we're going back to $60 oil that I would say I don't know, and I don't think many people do know exactly when it's going back.
I think the supply and demand of the market is rebalancing. In 2016, we're projecting demand growth to be 1.2 million barrels a day. Non-OPEC supply will contract 600 to 700,000 barrels a day, which means there's a 1.8 million barrel a day gap. Okay, and that's about equal to what Saudi overproduction or OPEC overproduction was last year. Okay, so I think that by the end of this year, you're going to see those numbers start to contract. Into 17, you'll start to see inventories draw down, and so you'll start to see the more normal where the market's going to settle. I think that'll settle around what the price is needed to sustain capital in the industry using a full cycle replacement cost number. Today, that number is $60 to $70 a barrel toward the end of 17. Now, that could change in my mind if China slows down or global demand slows, so that 1.2 million barrels a day doesn't materialize, and then maybe another 1 million barrels a day of demand growth next year doesn't materialize, so the numbers could be off depending upon demand, or if there's an exogenous supply event that we didn't think would come on. I don't think that's going to happen because supply is so challenged, not just in the United States, but we're in decline in Mexico, in Venezuela, in Colombia, in Nigeria, in the Kazakhstan, in the Caspian region. The North Sea is going to start to decline. I mean, these are high-cost areas that really represent so much of global oil production. It's not just, people like to look at the U.S., look at what North Dakota can do. North Dakota is interesting, but when you have 65 million barrels a day coming from non-U.S., non-Russia, and non-Saudi, okay, 65 million barrels a day, that ain't cheap oil, okay? And so that's really this big behemoth that needs capital to sustain itself. So I think we're going to end up in a place, provided the demand numbers are right, toward the end of 17 where the inventories will balance to a higher number.
Wayne?
I think I'm going to buy into the same replacement cost equilibrium number around 60, probably over a little bit longer horizon, driven by the fact that we still continue to have the agitation in the Chapter 11 market and the bond market, and the guys who aren't core E&P and private equity and business-driven guys in this market trying to work all that through. So I think we're looking at 40 at the end of 16 and 17, moving up towards 60 over a slightly longer horizon.
Okay, great. So it looks like we have time for one audience question. Hasn't there been a trend to avoid the cost of formal bankruptcy filings? Are more and more companies and creditors choosing to restructure out of court? Anybody?
I can take that one. I mean, I think yes, but bankruptcy is a very expensive process, and we obviously have certainly the largest, that some would say the number one bankruptcy practice in the country. I don't actually work in the bankruptcy side, but I will say that what my bankruptcy colleagues will tell companies that they go to see for the first time is that 75% of what they do is actually out of court. And they actually view it as a success in many ways if they keep a company out of court. And part of the reason for that is cost. It is an expensive process, and in many cases you lose control of the process. You obviously have exclusivity for a certain period where you can propose a plan, but ultimately you become beholden to kind of new masters with the creditors. So companies are trying to avoid it. That all being said, you do have to recognize reality. And no matter how expensive a process is, and no matter how difficult and challenging it may be, or what stigma is attached, in some circumstances, bankruptcy, unfortunately, Chapter 11 reorganization is just the right answer for a capital structure. So whilst you could keep them out of bankruptcy in some cases it's unavoidable because somebody comes to you, they come to our firm, for example, with, call it $1 million in their bank account, that company's not doing anything other than filing. But in other circumstances, it's a voluntary process because even though you may save some cash through not going, by not going into this process, ultimately, if you come out with a debt load that's completely unsustainable over the next 3 years, you're probably going in at some point anyway. So yes, companies always try and avoid it. We always say, and we mean it, that we will try and help them avoid it. But in some circumstances, it's just the right answer, unfortunately.
Okay. Well, it looks like that's all the time we have today. I want to thank the panel for joining us today. I've been talking with Wayne White of Eisner Amper, Ken Hirsch of NGP Energy Capital Management, and Andrew Calder of Kirkland & Ellis LLP. Thanks for watching.